Have you heard of the Trump taco trade? It's one of the biggest themes in investing this year, and coming up in Market Moves, we'll explain why it's a great lesson in not panicking as an investor. Plus, another interest rate decision for the Bank of Canada this week, and bank stocks, are they worth buying? It's all coming up in Market Moves, but first, a reminder that if you're curious about crypto, we're going to have a Bitcoin AMA live streaming right here on the Global X YouTube channel on Wednesday. All right. Let's dive in to this week's Market Moves. All right, let's start with this new acronym that investors have been eating up, the so-called taco trade. Now, this term was coined by a journalist at the Financial Times. It stands for Trump always chickens out, and it's supposed to reflect the wild year we've seen in the markets based on big proclamations from the US president, only to see some of those policy plans dialed back. Now, we saw that after so-called Liberation Day, sticking with the tariff tensions, with more directed comments for the EU or China, or even with some of the past comments Donald Trump has made about replacing the head of the US Federal Reserve, Jay Powell. Now, why should this taco trend matter to you as an investor? Well, if you see a big sell-off, and then very quickly some big buying, it is a reminder of both market volatility and the dangers of panicking. In fact, in our latest ticker take video on my YouTube channel, we talked about some of the biggest mistakes investors make, and that includes panicking. And as for this channel, be sure to subscribe so you don't miss our upcoming videos where we talk about some of the themes that investors should keep in their back pocket. All right, let's also talk about interest rates. There's a key decision on them this week in Canada. Will it be a close call? Well, interestingly, you've got on the one hand, noted economists like David Rosenberg, who, by the way, is going to be at the Globe Wealth event on June 10th. Global X will be there. You should check it out. Who are warning that Canada's economy is already in a recession and is very concerned about what's happening in the jobs market. On the flip side, you've had some GDP numbers that were better than expected, and economists at Scotiabank who are arguing that perhaps for the Bank of Canada, waiting for the balance of the year before potentially cutting rates next year could be the better path, especially so they can monitor what's happening with inflation in the interim. And finally, as everybody tries to figure out where the economy is actually headed, the biggest Canadian banks are setting more money aside for potentially bad loans. The biggest financial players in the country all just reported their quarterly results, and they all just increased their provisions for credit losses. Now, when they do that, it eats into their profits. As an example, Royal Bank of Canada, the biggest bank, did just that and ultimately reported results that fell short of street expectations, according to Bloomberg. But Royal Bank's CEO, Dave McKay, addressed this on a conference call with analysts, saying there is no downside in being cautious given this uncertainty. He added the bank can release those provisions in future quarters if a worst-case scenario does not materialize, and that would help profits in the future. RBC shares, which sold off after the company's earnings, remain the top ranked amongst the Canadian bank stocks, according to Bloomberg data. All right, those are this week's Market Moves. Thanks for watching. What Market Moves are you watching? Let us know in the comments. And don't forget to subscribe so you don't miss our next investing video. See you next time.